I'm not off mute. Hello? Hi,
Hello.
John. Hey, Leah. I don't know the order of who is in first, but we'll figure it out. How is everybody doing today? Oops. Um, okay, cool. Hey, Leah.
Hey, what's up? Morning.
I'm actually going down to the Panhandle in December. Not PCB though. I'm going to Dustin.
Oh, nice. Yeah, I think you were telling my husband because y'all were talking about golfing in Water Sound.
Yeah, I suck, but I I actually want to do some fishing, like some deep sea
Oh,
fishing maybe.
yeah,
There's a lot of good charters in Destin,
definitely. Who are you coming down with?
so I'm actually going to be speaking at an event. So I'm probably going to be flying solo, I think. But yeah, it'll be fun.
Nice.
Okay, good. I think we got more people joining, so let's go ahead and get started with questions. How about Leah? Do you want to go first?
Sure.
I'm gonna put you
I
on the
have
spot.
a lot. I was hoping there wasn't a lot of people today because I got a lot, but I'll keep it super brief.
Okay.
Um, I saw your email about all of the resources, the legal advice, the CPA, or not the CPA, the bookkeeping and
hmm
everything that it seems like a lot of people need. Definitely feeling overwhelmed in that sense because just handling the marketing, the bookkeeping, I feel like Stessa, maybe I need to upgrade to Pro because I feel like some of the things I really don't know how to categorize it in.
Mm.
I'm kind of getting bogged down in that.
Is that the supplies, right? They like they're really goofy with how they break out the supplies.
Right. Yeah. There's just a few things that I keep coming across. I'm like, do I put this here or here? Um,
I think what's important is as long as you're classifying it and you're actually documenting it, when it comes time for tax purposes, because there's the problem with Stessa is there's like 30 different categories that stuff can fall under, but
mhm.
on your tax return, there's only 14 line items to put stuff in. So we end up condensing it anyway.
Mhm.
And so I don't think it for tax purposes, I wouldn't worry too much. I guess from a profitability perspective, being able to track the fluctuation between are we spending too much on cleaning? Do we have are we spending too much on restocking or linens or stuff? That would
Yeah.
be something like having the breakout of what your supplies is would actually help determine if your rental is more profitable.
Okay. Yeah. And then to tag
If you
along.
wanna if you wanna send me over your Stessa, I could nitpick it for you
Okay.
and see.
Yeah. Yeah, for sure. Um, and then to tag along with that, oops, sorry,
No problem.
just trying to figure out. I think I saw either a post or something on a podcast, something dealing with if you have too much in one bucket under one category of your return, um, whether it be deductions or expenses, I don't really know what the bank is looking at as far as that goes.
Mm.
So still trying to remain profitable in that sense to where we're not kind of shooting ourselves in the foot, doing too many renovations, doing too many purchases, not creating too many deductions. And I don't even know if that matters, but we have a ton this year because we've done a lot of upgrades, a lot of furniture buying. Um, so I really don't know how that's going to look
Yeah,
as an
I
investment
think
standpoint.
I think you were. Oh, I don't think you were on the call for that one. So that is going to be the difference between expensing and depreciating. Um, and I need to do another separate video on this, but I'm gonna drop it here in the chat if you want to just open it and then watch it later. But basically, um, when you here, I'll just explain it again. Everybody can benefit from it. So when you have a cost associated to your property, it either gets broken down into two different categories. So it can be depreciated or it can be what's called expensed. So let's say you had repairs on your property or you had some startup costs getting it ready. They can either be depreciated or expensed. Now, if they're like supplies, linens, they're like incidental. I call them incidentals. I think that's how Stessa actually has them labeled too, like K cups, all this type of stuff. That's gonna be expense. But depreciation, furniture is a great example of this. Furniture can be depreciable or expensed, and it's gonna be determined really how your tax return and your lending shakes out. And so let me just go over the pros and cons. So the pros and cons of depreciating something. The pros of depreciating, and I should caveat this by saying you're going to see the same tax return result no matter if you depreciate something or you expense something. So your bottom line tax savings is going to be the same. It's just you'll see in a minute. So the pros for depreciation is that the lender will add back your expense. The lender will add back depreciation for purposes of income on that property. The con of depreciation is that you have that depreciation recapture sometime down the road, right? And then on the expense side of things, the pro is that there's no recapture down the road. However, the con is the lender won't add back expenses. They won't add back like repair expense, or they won't add back, maintenance items. So whether you depreciate or expense something, it really varies based off, I call it your season as an investor. If you're just getting started and you have your first or second property and you really need the income from the properties to help you qualify for more loans, then you're going to want to depreciate as much as possible because the lender will add that back to your income. If let's say you're higher W-2, you have 4 or 5 properties and you don't really need the income from your properties to help you qualify for other loans. Maybe you're doing mostly DSCR or commercial where you don't even need tax returns. Then you want to expense everything as much as possible. What we do actually for clients, if they're neck and neck, is if they're worried about this, I think we did this probably about a dozen times this year. Well, where we'll prepare 2 different tax returns. We will prepare one where a lot of these items are getting depreciated, and we'll prepare one where a lot of them are getting expensed, and we'll have you bring it to your lender to see what they say. If the lender will qualify you for an upcoming purchase with everything expensed, then let's do that one. If they're like, no, we need you to add all those back, then we'll show them the tax return with depreciation. Totally legal, nothing bad, nothing wrong here. It's just a way of how you present your financials for tax purposes. Does that all make sense?
Yeah, for sure. Because I think when it was explained earlier, it didn't click, but that's definitely more clear. And I guess it's really, we don't have to figure out on the front side of things which is which, what we're
That's
spending.
right.
Okay.
Yeah. I'll normally because I'll know, because that's part of like being in this program is I'm gonna know everybody's situation. And so just speaking out loud, like I know if you're gonna be looking to get more conventional or like secondary home loan type products, that you're gonna wanna be depreciating most of that stuff so you can add it back to your guys' income.
Yeah. Okay. Very good.
Ryan,
Hey
yeah,
guys.
a quick follow-up to make sure I captured my notes right on that.
Okay.
So right now we're not imminently looking for financing, but we're thinking maybe next year, right? So I think what we're talking about today would be our 23 filing, right? Like the real-time things we're buying right now this year and how it could affect our borrowing next year. Is that basically what we're talking about? Like,
Yeah.
when the lender looks at our return for the current year. So what I wrote was if I qualify with expenses, That's great. And if not, I would flip it to depreciation if possible. Was
Yep.
that accurate?
Yep, exactly.
Thank you.
Yeah, and I mean, so I'll say this too, because I think it'll probably get brought up on another webinar or another weekly event, but extending your tax return, like instead of filing in April and you file in October, there's like a lot of myths out there that extending your tax return triggers an audit. It doesn't. There's no audit trigger for extending. The only thing that's going to trigger an audit if you do shady stuff within your tax return, but just extending your tax return doesn't trigger an audit. And so a lot of times when you are not sure if you're going to need to present your tax return for lending purposes, like I have a client going through this right now. They have like a sale of a business from last year and it is really complicated. So we're trying to legally as possible show him as a good candidate to qualify for a loan, again, as legal as possible, but extending that return out from April to October gives you that extra 6 months of knowing that decision, like knowing if you need to go conventional or traditional underwriting versus non-QM like commercial or DSCR product.
Thank you. I think in our case, what's going on is the age of our property. A lot of things are wearing out.
Exactly. Yeah.
Right. So like we bought washer dryer set. Our HVAC is looking kind of weak, right? So those are, I don't know. I think they're kind of no-brainers for depreciating just because of what they are.
Yeah.
So thanks.
Yeah, you're welcome. John, you got a question?
Yeah, just curious. I've heard you talk about before the timing of the purchase and whether it's part of the setup cost versus it's something you have while like I have one short-term rental, so like when it's active, does that impact that depreciation versus expense equation or no?
Yeah, if you bought the hot tub before it goes live, it's gonna be yeah, I guess what was the cost of the hot tub?
2,000.
Okay. So that you could actually you could expense that if you want to because it's under $2,500. You could either so in your case, hot tub goes in before the short-term rental went live, right? So you could either depreciate the hot tub or expense it based on what's more favorable for you for lending purposes, right? Or just overall scenario. A lot of the stuff that I do now is I do a lot of like DSCR commercial debt, and so I mean the banks will ask for my tax returns, but they're not like counting up my Schedule E's, and so I try to expense everything because I don't need the properties to show income. Does that make sense?
Yeah, it'll be a little interesting, and there's just very situational because I had one guy who he reinforced the deck, he put in electric, and he got me a hot tub, and then he charged me on one bill for all of it. So I don't know if I'll be able to.
Are you able to have him break that out?
Yeah, I mean, I could probably reach out back to this guy and see if he could, because it was on one charge.
Yeah, so I would have them because what you just mentioned there, like the deck and the structure type of items, those are going to be treated totally different than a hot tub. And so try to go back and have him break out that invoice if you can. No, good questions so far. Steven, did you go ahead, John? If you had
I was just gonna maybe pile on to one thing Leah said at the beginning, but I also have trouble when I'm breaking up. For me, it's supplies versus repairs, because the same trip, I'll go to Home Depot and I'll grab a supply and a repair. Do I need to be trying to break those out like super detailed, or it's one charge for whatever it was?
It shows up on one as
like a receipt. My example, I was at my cabin last week and I got gravel to fix a part of my sidewalk. And then we also just got some supplies for the kitchen.
Yeah, good question. I haven't really, I mean, because you're not gonna swipe each item individually. I would say whatever you think is most dominant there, put it under that category. Like if it was more repair and maintenance, put it there. If it was supplies, put it there.
Okay.
Because I agree, because when Home Depot shows up on Stussa, it's gonna be one bulk item. You're not gonna have time to go and break everything out.
Okay, if nobody else is gonna go, I'm gonna jump in and ask about the call setting. When do we need to start that?
So it technically doesn't need to be done until you go to file your tax return.
Okay.
I'm just thinking in your scenario,
Going the DIY route.
yeah, I would also get it done before the end of this year, because you'll be able to take it as a deduction this year rather than, because if you, let's say it's February or March 2024 and you buy it, you don't get to expense it until that following year's tax return. So if you know you're going to do it, I would probably get it done in December.
Okay,
If
how
you're
long
gonna
does it take? Usually about a month or?
The
What is-
DIY route, you can get it done in the same day if you have all your documents. I actually have a video on how to do that.
Okay.
If you're going to go the DIY route,
Mhm.
you're going to need, I'm just trying to get off the top of my head. You're going to need your closing disclosure. You're going to need your appraisal, and you're going to need well, you have a condo, right? So there's no land, right? Okay. Yeah, normally you would need your appraisal, closing disclosure, and then whatever the breakout between building and land is.
Okay. Which I'm guessing I would get that from the county.
Yeah, I think you're the only place I would check is maybe your HOA bylaws or the CCRs. They might say whether or not you own part of the land.
Okay.
That could be somewhere I would probably actually check there first before you or just ask somebody like, oh, do we own part? 95% of the time you don't, but sometimes you do.
Can I ask a question on the land portion
Yeah.
there? Because I actually got, luckily in the mail, our Sever County breakdown for our land versus property. But my question is the total property is about, I don't know, a fourth of what we actually paid and the property was assessed, for the property. Like this says my cabin was worth 141,000 total.
Yeah.
So is
Yeah.
that common that it's
What is
off?
no, yeah, the appraisal for the county is always lower than whatever your purchase price is. Because
Okay.
what they're basically saying is like that is what they think the structure of the property, I guess, is worth versus what it's actually worth. Like
probably accurate?
so all you're gonna do is, and I've seen Seavers before, but there should be something that says like improvement value versus land value. And if you want to just send me a quick picture of it, I could show you exactly, but you're gonna get a ratio from there, and then you're just gonna multiply that ratio by whatever your purchase price is.
Okay, so it says I see it here. So it's 25%, and I'll use that. That sounds accurate.
No, don't use that one.
Oh, okay.
That's what they do. They take that for your property tax. Just send me a picture of it. I'll show.
Oh,
I'll
okay.
show you. Yeah.
Hey Ryan, I have a question.
Yeah.
Good to see you again. As far as like, I was talking to Bill, and obviously we were questioning one of the STR, the Palm Springs STR, as far as it being profitable, and obviously with with the whole value of money or time of money, like you taught me, the benefit that I'm getting from the current property, I can probably sell it and go, make some more money somewhere else. So
You
obviously
think
there's a
so?
cost
Though?
What's that?
Because I mean, I got your email. So like, if you're gonna net 70K on that property, is that right?
No, that's between two properties.
Okay.
Yeah, it's 40. I'm netting 40 on that property, and the other property I'm netting 30.
So, Do you mind if we break it out live here?
Yeah, no, go ahead.
Okay.
Sorry for the
So the-
misspellings. It was like one of those frantic late night emails.
No, you're good. So, okay, so you're saying that you're gonna, and so just so we're on the same page, like, uh, you're gonna net 40 grand on the property.
Yeah, I have been, the last 2 years.
Okay.
And I am this year again.
So your fair market value, you think you could sell it for 1.2 right now?
Yes. Yeah.
The loan balance on it is how much?
Well, I put 20% down, so 2 years ago it was 720. I don't know what it is now, but
You bought it. I thought you bought it for
I bought it for
900,
nine.
right?
Yeah, I put 20%
So
down.
your loan balance. Let's say the loan balance is 700.
Okay.
So this is what I do in Kajabi. There's a much larger breakout of this.
Okay.
This sort of idea here, but your net equity, if you were to walk away right now, 500K. Okay. 1.2 fair market, 700K loan balance. But you also have to consider closing costs from realtor.
Mm-hmm.
So that's gonna eat off your let's just say it's 6%. That's gonna eat off your fair market value. That's 72. We could tax strategize or plan around taxes because that also has to take into account. But before we even get into that, your net equity, if you were to walk away before taxes, is 428 grand.
Okay.
And so if you're gonna tell me that your net income on a property is 40,000, what I do then is I establish, and then guys, if this is like too super high level, let me know. We could break everything down and keep chipping away at it. But your break even, which represents how many years do you have to rent this property out to make what you have in equity, right? Because right now your 428 grand that is essentially yours is making you 40,000 bucks. So then you figure out that your break even in years is what I call it is 10.7. So it's gonna take you 10 years to make what you have in the property. If you do 100 divided by 10.7, that represents how much money how much percent your money is making you.
Right.
So I typically recommend it's like 9.35. Sorry. I typically recommend that if your break even for a short-term rental is more than 8 years, that's when I think it's time to look. But truthfully, right now, with a few things in mind, like I guess the question is, because what you're also looking at is what's my next best alternative? Because if you're gonna take this 428,000 in equity, and the best that you can get right now is at best you're gonna get 15% cash on cash. That's just what deals are doing right now.
Right.
So at best, your 428 grand is going to make you 64,000 bucks. You also have to worry about navigating around taxes because you did cost segregation on it.
Right.
So for you, like in my opinion, the 24 grand that you could make more on the property, and that's best case scenario. Like you could find a 15% cash on cash property. To the hassle of selling this property, buying another property, and then having to worry about the tax benefits, I don't think it's worth 24 grand.
Okay.
To me.
Gotcha.
Now I just ran this for somebody, client, the other day, and her break even was like 25 years. She actually had a place in Destin, and she bought it in 2020. Place in Destin, making 40 grand a year, except $1 million of equity in it. So whole different conversation because her, $1 million of equity only making 40 grand. It was like a 2% return. It'd be like a 50-year break even. I'm sorry. Yeah. What did I say? 25-year break even.
Gotcha.
Does that make
Okay.
sense?
No, it makes a lot of sense. Yeah, I mean that's kind of what I was anticipating. And then the other part of my question was like I know I've been letting the dog, what do they call it, the
Tax sale, right?
dog's
The dog.
tail.
Yeah.
Yeah, yeah. I read it like 5 times this past weekend, but um because I was gun ho about getting another property, right? I was like, okay, cool, take advantage of the 80% bonus depreciation. Like this is great. Like do another one. And then I started realizing, well, maybe this property is not the best fit for what I'm trying to do. But I wasn't so sure. But I appreciate you doing this because, yeah, I figured like there's things that I wasn't looking at. Like, is it worth all the hassle of going through a sale just to see if I can possibly perform better? I don't know how much it matters, but this house has a 2.9, rate on the loan.
I mean, that factors in too, right? Because you're gonna go. I mean, that I don't want to call that a sunk cost, but that's like a stab in the back if you go from 2.9% fixed rate debt to I mean, you're going to get 8% on conventional right now. It just makes it super hard to make money.
Right.
And like I said, there's just a lot of uncertainties right now and again, that return on hassle to where I don't think that 20 grand is worth it.
Okay. And if I could, just one more question. The other thing that similar situation is I'm trying to see if it's worth all the costs and penalties to go buy a property. Cause I think I mentioned the money that I have to play really is the money that's in a rollover IRA that I've had for like 10 years. It just sits there. It's about 140 grand. I know if I take it out, there's that penalty, right? And then it gets added into my income, I believe, right? At the end of the year. Yeah.
It's a rollover
So I was
traditional IRA.
Right. So I was thinking, like, is all that penalty stuff worth it just to go get a property to do a cost segregation to save money on taxes for my W-2 and the current STRs? Like, yeah, maybe I might save some taxes, but then I threw a bunch of money away by just withdrawing it from this specific account.
Yeah, I mean the whole kicker here too is like your IRA money is stacking on top of your W-2 already.
Right.
So you're already making money at W-2, like the IRA stacks on top of that.
Yeah.
And so your IRA money is essentially getting taxed at 30+% plus the penalty. So in order to like really offset that, you have to buy a lot of property, number one. And then number two, you just have to be comfortable with like, well, I'm going to lose 14 grand right away to the 10% penalty, which you can't offset the 10% penalty because it's a different tax then. So it's almost like, I mean, is the 140 grand you have, is that all that you have in a 401k, or that's just
no, that my 401k is different. This is just a rollover IRA that's just
I mean, again, so a lot of other people that in this space are a lot more like feely based, sort of like, oh yeah, go pull the money out of your 401k. You're never gonna get rich. Nobody got rich investing in 401k. I'm more of like a numbers sort of detail person where I'm taking that 140 grand that is in an IRA that's earning you 8 or 10% a year. I'm projecting that out over the next 20 years, doing absolutely nothing. There's no ROH on your aspect of leaving it in there. Versus, okay, what does it look like if we pull the 140 now? Try to navigate taxes. We're losing 14 grand to penalties. Now we're left, at best, let's say you take major hits, that 140 essentially is going to be like 90. 80 when the government's done with it. Can you buy a property with 80 grand that over a 20-year span is going to make you more money and more money that's worth the time than what it is sitting in an IRA for the next 20 years? Does that make sense?
Yeah, because the compounding obviously aspect of it too, I guess I didn't take into consideration. Okay. I mean, yeah, that's kind of how I was feeling. I mean, I think that's like, kind of what I assumed.
Because a lot of people, honestly, right now, a lot of people aren't factoring in the return on hassle. Like, how much time does it actually take you go and do all this stuff. It's like one thing to see the numbers on paper and it's okay, that makes sense. Just the same way. It's like, oh, 65 grand instead of 40 grand, sign me up. But if it's going to take me 2 hours of manpower or however much time to get into that situation, it doesn't seem as enticing anymore.
Gotcha. Okay. I appreciate that.
Yeah, you're welcome. Yeah, good questions, guys. Awesome questions. I think we had somebody else join. Hey, Leanne.
Hey, Ryan. Sorry, I'm in another meeting at the same time. So
Okay.
I'm just lurking again.
I got a couple more, but this is my first meeting, so I can always save some. We
Sure,
talked
go
a little
ahead.
bit about the depreciation. This is probably pretty basic, but I understand, I guess, the difference between the depreciation and then having a cost segregation done. There's a lot of podcasts on that portion, and I feel comfortable. I just feel like I missed the what's the normal. So in a normal year, no cost segregation, we can claim depreciation on the property. Can you help me understand just that aspect? And then do you have to pay that back if it's, if this is just
We haven't
normal depreciation?
done our one-on-one yet, have we?
Not yet.
Let me
And we can
let me
save it if it
no, let's are you married or single? Let me
married.
okay. What just give me if you don't mind sharing like roughly like what are you guys what's your W2 combined?
All right. Well, so it'll change a little bit this year. I should come in around 140, 150-ish.
Okay.
I'm full-time. My wife is PRN and she'll come in. She's the bigger variable, around 15 to 20.
Okay. Yeah, I think I remember that now. So 170 combined. Okay. What was the purchase price of your property?
490.
Yeah. And I just actually got your picture. So what you're gonna do there, and I don't know how to share this in the Zoom so everybody can see, but you see how it says land value and improvement value?
Yeah.
So yours and actually their website's like the easiest one to do, honestly. And you'll also find out that the Smoky Mountains is like the #1 place to invest for tax benefits because the land is so damn low there. So your improvement 116, land is 25, add those up, it's 141. And then you divide the land by the total there. And then that gives you the breakout between building and land. Actually, this is kind of high for the Smokies, to be honest with you. So it's 17%, let's call it 18% land, and then 82% building on a 490 purchase. When did you go live in service?
End of March this year.
Okay, so you've been in service for 8 months. Let's say 8 months total. So this kind of shows you regular depreciation on this property. You would get about $6,800 a year. That's going to be the building value divided by 39 and then multiplied by the amount of months that you rent out the property for the year. In your case, it's 8 months. The cost segregation kind of shows you, well, what happens if you accelerate 25% of that building value. And so then this sort of calculator, this is what I use for people, is it'll show you basically, okay, what depreciation, if we don't do the study, this is how much depreciation we get in the first year. If we do the study, then this is how much depreciation we'll get. Again, these are, spaghetti on the wall averages, but this kind of gives you a visual of, so let's play this out. So let's say you were to just take regular depreciation on this would be $6,800. You're gonna save let's see, your income tax savings $7,800, and then if you had the cost segregation depreciation tax savings in the first year $24,000. So do you notice how it triples your, at least the first year, it triples your tax savings?
Yeah, no, absolutely, because you're accelerating. Do you have to pay a recapture on the just that 6,800 if I were to sell in a couple of years?
So you do pay, so you pay recapture on whether or not you do cost segregation or
Okay.
not, you do pay recapture. So, and this is like extremely nerdy, but just hear me out. So normally if you had, let's say, I'm just gonna use easy math, but let's say you had a building that was worth 390K and you depreciated it for 3 years. So depreciation per year, let's say, is it would be 10K. Years 3, that's going to be 30K. When you go to sell that property, the 30K you pay back normally is taxed at it's actually taxed at your marginal tax rate, but it's capped at 25%. So the most that you would pay is 25. If your numbers were the same, let's say you're similar W-2s, you would actually be in a you guys would be in a 22% tax bracket. So you would actually pay less than the 25%, but this is capped at 25%, right? So so that $7,000 that we were saying, you would essentially pay that back when you go to sell. Now, with the cost seg, the way that it works is we have that same building value, 390, except you're going to have normal depreciation, which would probably be it's not going to be 10K per year, but it'll probably be something like 6K. 3 years is going to be times 3. That's taxed at 25%, same way that this one is. The accelerated depreciation, though, is taxed at whatever your tax bracket is in the future. So if you're in a 32, 35, 37% tax bracket in the future, this accelerated depreciation gets taxed at whatever that rate is in the future.
I'm sorry, Ryan, this is Azalea. Good morning. I didn't follow how the depreciation decreased from normally to the cost seg.
So the depreciation is going to decrease because
Of the land value?
When you do accelerated depreciation, you're going to be depreciating all the like furniture and millwork and cabinets that otherwise would have been included in the total. Maybe if hold on, let me pull up a report. Maybe it'll make it look a little bit more aesthetically pleasing. Also, guys, I do have to go in 20 minutes. We're actually doing our wedding rehearsal today, so I have to get moving after this. Let me share it. Let me know if you guys can see this.
Yeah.
Everybody can see this? Okay. So this kind of shows this is just an example of like a depreciation, but where am I looking at here? So the 39-year property, that is normal depreciation. When you do cost segregation, it's taking away from the 39-year and it's moving it into 5 and 15-year property. Those are going to be like, for example, they don't have it here, but those are going to be like furniture, millwork, cabinets, dishwasher, dryer, ceiling fans. Those are going to get moved into 5 or 15-year type property. And so that's why the depreciation, when you do cost seg, the regular depreciation isn't as much as it is generally. I don't know, maybe that's.
So then where does the rest of the depreciation come in? Because I thought overall it's increasing.
Well, yeah, so the accelerated depreciation would be normally 25% of whatever the building value is. So you would have 97K of accelerated depreciation, and you would have $6,000 a year of normal depreciation. Does that make sense?
So normal depreciation doesn't go anywhere, even though you're doing the cost seg and accelerating depreciation?
It does. It gets reduced.
Oh, because you've removed some things out of the bucket, but you haven't completely removed
Yes.
the bucket. Okay.
Yeah, it
That's-
doesn't go all the way. So that's why, like, on this I gotta go back a while. Crap. That's why on this calculator that I use, I actually project out what your next year's depreciation is going to be based on these numbers. So when you do accelerated depreciation, like, you're always still going to have leftover depreciation. It's just, I mean, it's never really enough to cover the rental income on short-term rentals. Long-term rentals or multifamily typically we don't see people actually pay a taxes on long-term rentals or multifamily for like 5 or 7 years, because the depreciation is normally enough to cover the cash flow on those. But for short-term rentals, because they make so much money normally, you're not gonna have enough depreciation.
Hey, Ryan. So for like my example that I emailed you, where I have a carry forward of 57 grand for this year of depreciation. So essentially, when they say $57,000 and my properties are going to bring in 72,000, am I literally going like dollar for dollar? That's based on how it's going to combat that, or how do I calculate that? Got it. So then at the end of the year, 70 minus 57 is 13,000. So I'll show a profit of 13,000.
Yeah, but then also add in the depreciation, right? So
gotcha.
Yeah, so it'd be your carry forward loss plus whatever depreciation. That's essentially how much money you can make in rental real estate without having to pay any taxes on it.
Gotcha. Okay.
Yeah.
But obviously, it's not going to be enough this year for like our regular W-2, which we benefited from last year.
Right. Well, and you're just going to have more income on the rental side, right? Because you're going to have these properties that are in service for the entire year, as opposed to whenever you bought them last year.
Right.
Yeah.
Okay.
Yeah. Do you guys like the format of these? Should it just be straight Q&A? Should I do more teaching, or like, what do you guys feel?
I like this. I mean, I don't mind sharing my personal stuff, so I think I benefited from it more like this. But it's just my take.
I like this as well, because everybody's situation is something that I may come across in the future. So even though we are not going to necessarily use it this year or maybe even next year, it's just something that helps us plan ahead. Kind of helps us think outside of the box and look at different things.
And I guess on that take, Ryan, so like, for example, obviously trying to plan for if I'm not going to buy a property based on kind of the numbers that we've been running, and I'm not going to sell a property, and I'm going to end the year like I'm going to end the year. Obviously, I need to start thinking about that tax bill, right? What would be the best case scenario to like sync up with you? Obviously, last year you were kind of tapped out, so you referred me to I think STS Summit. But obviously, having these conversations with you makes it it's easier for me to kind of explain, I think. But I guess we could take this offline, but I just thought of that right now. I need
to so we can make it really easy. Can you go into Kajabi, and there's a module in there that's I'm gonna show you where exactly to go for that. But if you can fill out and do most of the legwork on this, I should be able to come in and do some high level oversight. Actually, we won't have office hours next week because I'll be in Jamaica, but we'll get you the week after. But if you go into the site and you go to tax planning for their current year, there's going to be the 2023 blueprint. And so
Okay.
this has a video of exactly how to do this, but this is exactly what I was just showing you. You're gonna pretty much input your and I think Leah, you were on the call, we walked through this, and Steven, you've seen this before too.
Yeah.
Actually, I think I have yours. I'll just send you it. But clean this up a little bit as far as income information so far, and then
Okay.
we like I said, we can break it down in 2 weeks on the next call.
Awesome. Okay.
Yeah.
Cool. Yeah. I'll wait for your email then. Thank you.
You should have I should have emailed it to you a while ago. Check your email.
Oh.
You probably have
Okay.
this, but if not, let me know.
Okay.
I'll just
Awesome. I got to bounce. Thanks so much, guys.
Yeah, you're welcome. I'll talk to you soon.
So Ryan, you're away all of next week, but available, you have open availability the week after?
Yeah, I'm gonna be gone from October 2nd through the 8th.
Okay, and these calls are gonna be recorded, right?
All of these get recorded. Yeah, I trying to figure out where I want to host them at. But I have them all saved, so I didn't like the way Kajabi had a lot of the community feature, so I moved us over to a Facebook group. But I also don't like the way Facebook group shows videos, so I'm kind of like torn on where I want to host the videos.
Would it, just something to think about, I came in on this call late and I'm not always able to attend the calls. Would you consider like emailing out just a brief, highlights of the call?
That's a good idea. So that's why I have this little note taker thing. Because it's supposed to like transcribe our conversation, and it's supposed to like, and this is my first time using it, so I don't know if it'll actually work or not, but it's supposed to like, at the 13-minute mark, John and I talked about this, and it's supposed to, so you guys can go in and, okay, that boring doesn't apply. Oh, I need to learn about that. Like, let me go and click on that. And it should take you right to that part of the video. I literally just got that, but yeah, I could email that after the call to everybody. That would be an awesome idea.
Okay, thanks.
Yeah.
So just
go
a real
ahead.
quick, sorry about that. So you were saying you don't recommend any investments with break evens that are greater than 8. Is that what you were getting at?
So, okay. So cash on cash return is a different metric than the break even analysis. So cash on cash would be if I have 100 grand in cash, I want to invest that and earn 20% cash on cash. So at the end of the year, my 100K is in the property, but I have 20 grand of income in my pocket, right? That's 20% cash on cash. What a break even analysis is, and in that case, right, if those numbers work out, my break even is 5 years. If I can get 20% cash on cash, my break even is 5 years. I'm keeping the property. What a lot of investors have faced, though, and you know this too, is like over the last couple of years, the properties have risen up in value and appreciated to the point where they actually are making more money on the appreciation of the property than they are the actual cash flow from the property. And so, perfect example of this is the lady I was telling you about in Destin. She had, like I said, bought something 600K in 2020, makes 30 grand, 40 grand a year, but that thing went up to $1.1 million in value in 2 years, 3 years. So her cash on cash, she invested, let's say she did 10% down. So 60 grand on a 600K purchase. Let's say she was another 30 grand in for everything. She's all in for 90, making 30 or 40. Really good cash on cash back then. But now, because her properties appreciated so much in value, her cash on equity is poor. So I hope that like cash on cash, different than cash on equity or break even. Does that make sense?
Is she on the harbor?
I don't know where her I actually,
Durango Road?
I don't know. I never got the address from her actually, but
Because those
she,
are actually, I talked to some patients that
you know
they
where
were.
she is?
No, it could be the same person, but it was townhomes. My husband actually used to rent one, and they were selling for 300 about 3 years ago, and then they went up to 600 a couple of
Double.
years ago, and then now they're over 1 million. And yeah, they got out and moved back home.
So,
Yeah.
sorry, Brian, so what do you use at the end of the day is cash on cash 20%? If it doesn't,
That's what. Mhm.
if it's not 20%, get away from it.
That's a good rule of thumb. That's what
That's
we
hard to
use.
come by these days.
Exactly. So right now it's like 13 to 15%. But especially if you're I mean, all of us have like jobs and families and so that's where I think that return on hassle metric becomes super important, because if I have 50 grand, or let's say I have 100 grand and I can make 15 grand a year on a property, 15% cash on cash, is it worth time away from family? Is it worth extra hassle? Is it worth messaging people on Airbnb at 9 o'clock at night when something goes wrong? But yeah, I would agree. I think right now you're lucky to get 15% right now, just with where rates are at. I mean, certain markets it's achievable. Markets where people are not really looking at, I think it's achievable, and there's not as much competition. But yeah, 15% is probably what's going to happen right now. Good questions. John, did you have something?
Yeah, you might be able to point me to a video or something. The other day on Facebook, you mentioned someone was asking about travel expenses, and you said a gas versus a mileage method. I haven't
Yes.
seen anything on what the mileage method is.
Do you use your you use your vehicle to go to the Smokies?
Yeah, we drive. Yeah.
Okay, I just put it in the chat. Actually, I have the video handy.
Cool.
Yeah. There's two ways to write off the cost, the cost of traveling back and forth, especially if you're driving. You could either use actually, I'll caveat both ways. You have to track the miles, but there's a way where you can depreciate the car, which typically generates you more deductions, or you can just simply take like what's called a mileage method. And that video kind of explains like pros and cons of both, and when you would choose one way or the other.
Cool. That's perfect.
Yeah,
Maybe you had something around there I just couldn't find.
I got something for everything. At least I try. Like
A recorded video for everything.
What I had today about the equity audit, like I have that elsewhere, but I need to like tailor it down. I think one of the biggest mistakes one of the biggest mistakes I made so far is a lot of my stuff is super like complex, and my coach was making fun of me because they put one of my emails in a there's an app called Hemingway that tells you what level your grammar or your writing is in. My spelling is absolutely crap, but they put my email in this Hemingway, and it's like you have a 11th grade reading level is how you're communicating to your audience, and they're like, you really need to be at like a 3rd or 4th grade level so everybody can understand what you're saying. And I was
That's
like,
unfair.
yeah.
You have to use words like you have to. That probably just trigger you higher or something.
Yeah. I mean, especially, I don't know if you guys have seen like some of my first few podcasts that I put back in 2021, but I mean, I came out of the gate just like super highlight. Like, I wish I would have not like a accounting for dummies or whatever, but I really wish I would have just tailored it back a little bit,
Are we able to shoot you over vehicle details, mileage logs, just to get a quick idea if that's in the picture for us to do?
Yeah, sure. Go ahead.
Okay. And any virtual assistants that you recommend?
They're so trial and error. because a lot of them, you're not their only person, nor do you like need them to be only working for you. Like I have somebody that does all my email stuff where it's like I need her to only work for me, right? But I think if you got a couple of properties, like she's not going to only work for you.
Mhm.
So they're really hard, really trial and error. I would probably post on some of the Facebook groups and see like where other people got their VAs. I've gotten all my VAs actually on a website called onlinejobsph.com. The way that you want to do that, just a quick tip is you can actually post like job descriptions, and I would post like use ChatGPT to like write up a job description for you, but somewhere in the job description sneak in there like please respond with the word blank, and then that lets you know that the person actually read the job description and they weren't just like just mass applying. Because I'm actually trying to pull my account up right now just to show you what I'm talking about. But yeah, that's probably the best, because like I said, they're just so trial and error, which is also probably one of the biggest mistakes that I made in business too, is like, because you want to hire fast but fire faster is what one of my mentors told me. Because so let me show you what I did. Like, and my job description was complete crap, by the way. But yeah, I just like I said in your title, make you put the word learn like a CPA in there. And all these people posted that, or sent me a message with that.
Yeah.
So, but yeah, this is where I think I don't know how much it costs to post in here, but you can actually I tried getting a VA for my firm. It didn't work out. You can
Fiverr.
Fiverr might work too. I'm trying to get in here because one of these maybe I'm on a different. There's a setting in here where you can actually see people's like their resume basically. I couldn't find it, but like I said, whatever you end up doing is just trial and error. Like, give them a month's worth of stuff and see if they work out. If not, you got to get rid of them and keep moving on.
We're just at the point I can't juggle everything. Marketing,
Yeah.
bookkeeping, messaging, pricing adjustments, the optimization, renos. Oh, and then I have kids and another job, and it's just too much.
My recommendation would be, actually, now I'm thinking about this, is two things: Google Doc and Loom videos. So every time, like you just mentioned, like you're doing these things, pricing adjustments, you're going to film a video of Loom of you doing what it is that you're doing with a pricing adjustment. And I mean, they're not going to know like, oh, hey, look, whatever is happening in PCB right now, you need to change the price or whatever. But what we do is like, hey, here's us doing month-end bookkeeping or reconciling the account, or this is how you organize these documents. You film the video and then you link the video in the task description. So that way, and then next thing you know, like do this for a month, and the next thing you know, you got a Google Doc with 30 different tasks with videos of you doing it. So it's just super easy to just hand that off to somebody.
Yeah.
And in one of my businesses, like we've already gotten to the point where I'm having the VA train other VAs, because I had her go in, film the tasks, and then create the Loom videos, create the description, and then when I hire somebody else, I don't have to train them. The VA is going to train the other VA.
That's awesome.
Yeah. So that's my best advice. Like I said, I would spend, try maybe do these simultaneously, right? Like, figure out where you're going to get a good VA, but at the same time, like post a bunch of, or film yourself doing all the tasks. So that way, when you do find the VA,
That's good info.
'cause they're very direct people, by the way. They're like, not monkey see. I don't want to say monkey see, monkey do, but they're like very okay. Give me the task, show me how to do it. Like I'm gonna do it, and then it's not gonna be pretty. Like I have my BA. I'm trying to promote a new. We have a free live training / boot camp coming up soon, and so I had her do all my emails, but you know she's missing links and some of them, you know, so they're gonna mess up. It's just again because that's just how the world works. But I do got to get going. Did anybody else have any questions before I jump?
Thank you.
You are so welcome. I actually,
Congratulations.
yeah, thank you. I was just in touch with some people from Austin, the Jen Martin and the people that put on the event, so that we met
Oh,
at.
cool.
Yeah, I want to go back. I don't think my fiance is gonna let me go back, but
Has she been to Austin?
no, I should bring
You
her
guys-
with.
You guys have to come during South by Southwest because that is the absolute best time of year.
I heard about that.
Weather-wise.
Southwest Fest or whatever it's called.
What is it?
Southwest Fest or whatever.
South by Southwest. It's the best time of year weather-wise, and also the energy of the city is incredible. And there's music in every nook and cranny you can imagine, from $5 to, you know, big ticket people. So it's amazing. In March.
Yeah. Oh, it's in March. Okay. That's my birthday's in March. Maybe we'll go there for my birthday.
There you go. Let me know if you're headed out this way.
Okay, I will. We'll
Okay.
be in
Have fun in
touch.
Jamaica.
Yeah,
Oh,
thank you so much.
That's where we went on our honeymoon. We did White House,
Oh,
which is
yeah,
Sandals.
we're at the Excellence Oyster Bay.
Oh, nice. Excellent.
Yeah.
Nice. Cool.
Thank you guys
Congrats.
so much. Yeah, thank you. I'll talk to everybody soon.
Bye.
Bye-bye.
Bye, guys.